Thank you for being here with us in another weekly Wednesday webinar. As we see all the attendees coming in through the gates, we are so happy to see each one of you. Especially, we always mention this, and I'm always emphasize this. We know that everybody has a busy schedule. We know that everybody has a busy life, but we so are appreciative that each one of you takes the time to spend your Wednesday evening or afternoon, depending on where you are, with us. So we're gonna go give it a couple minutes for more people to join. But the topic of this evening is drum roll, credit reports and scores. We're gonna educate you about the credit reports, the scores, how it works, how it's weighted. So any questions that you may have, please make sure that you have them with you. But we're just so happy that you're here with us, and I'm sure that we have people from the East Coast, Northeast, West Coast, Central Time, Eastern Time, West Time, everything. But we're so happy that each one of you are here with us. We're gonna give into around 6:02-ish, but thank you very much for being here with us. And I'm going through the attendees to see, as usual, I see names that are very familiar. And I want to see, I see a familiar name already. Don Proctor. Don, you just got married. Congratulations to you. And you're back with us at the DMV. So thank you for being here with us this evening. We're just so happy that you're back, that you had a blast in your second home, which is Puerto Rico. Ya tú sabes. So you already know. We're just so happy about that. Let's see. We see other names. I see
Milton.
Hunt. I see Milton Hunt.
What
in
an
the house.
honor.
Milton Hunt, thank you very much for being here with us. This is how we do on the weekly Wednesday webinars. So Milton Hunt, you're gonna get me standing on tables, just you paved the way, then that's what you did. So I'm just kidding, Milton. Thank you for being here with us, and I hope that you learned something new today as well. With that being said, I see Mr. Ken, you're one of us, and Mr. Juan, I see you as well. So thank you very much for your support. And then one name I don't wanna forget to mention. I always see her, Miss Geraldine. She's always here with us as well on the Weekly Wednesday webinar. So thank you very much for being here with us. And then we go through the attendees after the presentation as well. I don't want to forget any shout outs or anything like that. So if I haven't said your name, don't feel left out. I'm gonna come back to you and say your name. With that being said, Milton, please take it away with the intros.
Hey Eddie, thank you so much, sir. And I now that I see so many familiar names here, and especially our very own Milton Hunt, who if anyone happens, if you don't know Milton Hunt, you definitely want to meet him. He is a motivational speaker. I mean, this guy, he will get you fired up in, I will say, less than a minute, 30 seconds probably tops, and he will get you to the point where you feel like you drank like 5 cups of coffee in less than 5 minutes. So definitely great to see you here with us, Milton Hunt. Thank you for joining us. I also see we have Shirley from Car Services. So Shirley, thank you for joining us also. We're excited that you are participating and being here on this little, what's the word? What's the best word to describe our Wednesday here in the East Coast? It's raining. So you can tell that spring is around the corner. So for those that love spring season, your season is coming. If you're like me that have allergies, maybe not so much. But everyone else, I know that we're looking forward to see all the the flowers, all the trees blooming and everything. So really excited. And with that being said, let's go ahead and dive in and start with the introductions here. As Eddie alluded to, our topic for today, it's going to be about credit reports and score. I'm not sure if everyone knows this, but March is actually National Credit Education. So we are really excited. So this is in line with what we're doing today, and we have a really great presentation. And as always, we have an amazing panel. You already heard his voice, Eddie Villanueva from the marketing team. He's going to be keeping track of all of the chats and the questions. So if anyone's have any questions, feel free to submit them either through the chat or the Q&A. And as always, our commitment is to answer every question before we let you go this evening. So again, highly encourage you to be to participate. And if there's anything that you want to know, if there's anything in particular that you want to ask us, please do so. We always love to answer those questions. And if we don't have an answer for you, give us 24 hours and we'll truly look for a way to find it. Also helping Eddie with the questions and the Q&A, we have Andrea Londono. She will also be assisting Eddie. And the person in charge, responsible for putting all this content for us, all the graphics, all the beautiful pretty much the slides that you're going to be seeing here. It's our very own Kerry Lazar from our marketing team as well. And myself, I'm the other Milton, not Milton Hunt, but Milton Aguilar Bolanos. I'm the membership development officer here for the credit union. So with that being said, I have only one person left to introduce, and that's going to be the presenter for this evening. So let's give a warm welcome to our very own Kim Freely, our membership development analyst, who is going to lead this presentation. So Kim, take it away from me.
Oh, Milton, thank you so much. Thank you so much, panelist team. And welcome back to another weekly Wednesday webinar, WWW. We are so excited that you have taken a portion out of your evening. I know everyone is busy to actually join us. We truly care about your financial wellness. We want to give you resources to be as financially well as you can be. So we have a lot to cover. Let me go ahead and jump in. So credit reports and scores, like Milton stated, it is National Credit Education Month. So we are ready to provide you guys with all kinds of resources, information, education that will help you be financially well. So we have a lot to cover, like I said, and it is all key to actually understanding your credit report, your score. We're going to start out by talking about credit. Why is it so important? Then we're going to take a look at actual credit reports, what's actually on them, and how to obtain yours. This is so critical. Your credit score, your credit report factors into so many things that you do in the world today. Then we're going to talk about how credit scores are actually calculated. This is not, there are so many factors, you guys, as to how your score is calculated and how to build credit. There could be someone on the phone on the webinar tonight that, hasn't established credit yet. We're going to go over that. And if there's not anybody and you have a son, a daughter, a niece, a nephew, a friend, somebody that you can help mentor, it is so important. This information is actually not shared in schools anymore. And one of my goals is to get this information back into the school system. So we'll also talk about a couple common credit myths before wrapping up with some tips on using credit cards wisely. So why is credit important? Before we get started on the ins and outs of credit reports and scores, it's so important to actually take a step back and consider why. Why is credit so important in the first place? And believe me, it is. So do you think that having a good credit history, a good credit report, a good credit score could actually land you your dream job? Do you know, you're not going to believe this, 38% of employers do credit checks. This doesn't mean, you guys, that having bad credit will prevent you from finding a job, but it may be used in determining if you will be offered certain jobs. It could be your dream job. It's important that I tell you that employers only have access to your credit report, not your credit score. And whether or not credit is a factor in gaining employment, it's largely depends on the industry that you're going to go in. So like us here at the credit union, if you work in finance, it could, of course, be a big factor, as well as jobs that require security clearance. So I'm going to just give you an example. Think about if you were to want a job at an airport. Did you know that TSA, the Transportation Security Administration, they're going to do a credit check on all prospective employees. And if you owe $7,500 or more in unpaid debt that's in collections, they are only going to hire you if you show them a plan to pay that debt back. That seems really astonishing. But you know, it's really good that they actually want your, just like we do, your financial wellness. We want you to be as financially well as you can be, because we're going to talk about how your credit score impacts everything pretty much that you do. So renting or buying your own place, your credit history is absolutely going to come into place when you rent or buy a home. Even though when you rent, you're actually doesn't actually involve purchasing a home. But the rental management companies, almost every single one of them, will still pull credit because they want tenants with decent credit, as it really does indicate that you're more likely to pay your rent as guaranteed on a monthly basis. And if you're purchasing a home, you know, credit absolutely plays a big role in determining if you're going to be eligible or not for a mortgage. So why is credit important? You know, getting a loan when you need it. Having good credit might make the difference in getting a loan when you need it. Anytime you need to borrow money, your credit absolutely is going to play a big role in determining what terms of the loan, and could even determine what rate you get, what interest rate you get. So we're going to talk a little bit about that as well. But what happens if you want to borrow money and you don't have good credit? So this is one of my biggest takeaways. If you do not have good credit, if you know someone that you're mentoring, that you're helping that doesn't have good credit, there's a lot of those advertisements out there, you guys, that says bad credit, no problem. And what you have to realize is those places often automatically approve you for a loan, but it's more than likely going to be an extremely high interest rate. And just to give you an example, you might get an auto loan, get this, at 25% interest rate, which might translate into, you know, higher monthly payments. More than likely, they'll double, they'll triple when someone with good credit might pay. So, you know, I call them loan sharks. I mean, just bottom line, that's what they are. And more than likely, someone who is going down that road, it's just going to be a domino effect, and it's just going to get worse and worse. So, let's talk about, let me give you a few examples here. Let's take a look at two people. They're actually applying for a mortgage. And just for sake of discussion, we're going to say that for underwriting pieces for Diego and Angela, we're going to say they're equal. We're going to say that they have equal amount of income, they have stability of income, etc. While Diego and Angela might both get approved, let's take a look at how the difference in credit scores impacts the term of their loan. So let's look at Diego and Angela. So you can see the slide in front of you. The credit score for Diego is 660. Angela has a credit score of 750. So for this 30-year fixed mortgage for $250,000, Diego's interest rate is going to be 5.25. Angela's is going to be 4.63. Look at the difference in the monthly payment, but look at the difference at the total paid over 30 years. That's a lot of money. That is a lot of money. While it might look like a big difference to you guys spread over 30 years on a large loan, a difference in credit scores can actually translate into literally tens of thousands of dollars. So it truly does matter. Here we have another example with Diego and Angela on a $250,000 fixed rate mortgage. You know, what advice would we give Diego before he decides whether or not to move forward with purchasing his home? he might really want to consider focusing on increasing his credit score before buying a home. A lot of times we will tell members, we will tell our friends, our family, when they are ready to apply for a loan, you really need to check your credit report, your credit score at least 6 months prior to. And that way, there's not going to be anything surprising to anyone. And if you need to work on a couple things, 6 months is plenty of time to do that, because you're going to want to get the absolute best rate and lowest payment that you can. That is how you are financially savvy and makes you financially well. So, you know, the interest rate matters. You know, actually jumping into such a large purchase before you are ready, credit-wise, it could mean your dream home becomes, you know, more of a nightmare. And that's the last thing. There's enough stress out there in the world. That's the last thing people need. So that's why we're doing this webinar tonight, just to help you understand how important, how critical it is to have, you know, a financially well credit report and credit score. So now let's talk about, you know, turn our attention to credit reports. As a credit report actually contains some of the most important pieces of information creditors look at when determining if and at what term they are willing to extend credit to you. There are 3 major credit bureaus that collect your information and generate credit reports. There's, you can see it in front of you, TransUnion, Experian, and Equifax. And when it comes time to apply for credit, I don't know if you know this or not, but different financial institutions may review different credit bureau reports. Like here at the credit union, we actually use Experian. So when you apply for a loan, apply for membership here, we're going to pull Experian. And in some cases, like let's say you're going to apply for a mortgage, the lender actually may pull all 3 and review all 3 of the credit bureaus. This is part of why it's important to be on top of what is being reported with all 3 credit bureaus. While they're typically the same, sometimes they're not. Sometimes they are actually different. And it's really important. We highly recommend that you review your credit report from all 3 bureaus at least once a year. And we're going to talk a little bit more about that because the Federal Trade Commission did make some changes to how often a consumer can view their credit history. So different information, like I was stating earlier, may report to different credit bureaus. In most cases, the information, it'll vary just a little bit, as some creditors may only report to 1 bureau versus all 3. And so the report could be different at different times. It's all based on who that creditor actually reports to. So what is on your credit report? So what's on your credit report with each of these credit bureaus? First, your credit report contains, of course, your identifying information, personal information. This includes things like your name, of course, your social security number, your date of birth, your address, sometimes even your employer. Sometimes I see employers on credit reports, sometimes I don't. So this is used so that whoever is accessing your credit can match up your information. And this personal information is not used at all when calculating your credit score. But I'm going to tell you, there are a lot of factors that go into your credit score. So second, we're going to talk about the next thing that's on your credit report. We talked about personal information, credit accounts. So this is going to include things like credit cards, personal loans, auto loans, mortgages, any student loans that you may have, and any other types of debt. It's going to contain information about when you opened that account, if your payments have been made on time or not, your remaining balances, and your maximum credit limits. Payments will show up as late if you are 30 days or more past due. So it is critical that you make your payments on time if you want to have good credit history and a good credit score. So We talked about personal information is on your credit report, credit accounts are on your credit report, and collection accounts are on your credit report. So, and just so I'll let you know, other household bills like rent, utilities, those generally do not show up on a credit report. However, I want to make sure that you know that if you stop paying any of these bills, they can be referred to collection agencies. And once in collections, the collector can report the debt, at which point those outstanding debts will appear on your credit report. Again, bottom line is, paying your bills on time. So under the Fair Credit Reporting Act, debts can generally appear on your credit report for, get this, 7 years, and in a few cases longer than that. So public records are also going to be on your credit report. Don't know if you knew that or not. Those are things like bankruptcy, tax liens, judgments. Those can stay on your credit report for 7 to 10 years. 7 to 10 years, that can affect you. And then, of course, inquiries. So inquiries are also on there when you, inquire, like you put in a loan application. Any inquiries at all are going to be on your credit report. And there's 2 types of inquiries. There's we call it a hard pull, a hard inquiry where your credit report is pulled, typically for purposes of you applying for a loan when credit is being extended to you. And then a soft inquiry is things like you pulling your own credit report, or when a current or potential creditor, they can actually pull a soft to give you a promotion. So you will probably all get, letters in the mail. Hey, we're doing a promotion, 0% interest for 2 years. Those are actually soft credit pulls. But while both hard and soft inquiries will appear on your credit report, it's important for you to know that only hard inquiries impact your credit score. So let me tell you what's not on your credit report. Your income, your assets, your savings accounts, how much you have in your savings. Those things are not reported on your credit report. So a person can have excellent credit, but no savings. Or on the other hand, be very wealthy, but have poor credit. So this is why lenders will often look at all those pieces, all those different pieces of a financial picture. Income, they'll look at assets, they'll look at savings, they'll look at credit when they actually make lending decisions. And I want to make sure that I'm going to say this throughout this webinar presentation, a credit score is not a financial health score. It is not a financial health score. So what's on your credit report? There's no requirement in the Fair Credit Reporting Act for credit reporting agencies to actually remove positive information, such as loans that you paid on time. They can remain on your credit report indefinitely, which is not a bad thing, especially if the account remains, if you keep it open and active. Even after a positive account has been closed or paid off, it honestly can still stay on your credit report for as long as 10 years. And having more good information helps actually to strengthen your credit history and increase your credit score. So it's a good thing. So how do you get your credit score? Obtaining your credit score. This is very important to make sure that you keep up with what's on your credit report, because the quicker you find an error or something that you did not borrow, you can get that taken care of as quickly as possible. So it's so important to make sure that your credit report is accurate. So according to a study conducted by, and we're going to talk about the Federal Trade Commission a lot, the FTC, get this, 1 in 5 people have an error on at least one of their credit reports. 1 in 5, you guys. So let's talk about how to get a copy of your credit report. We always recommend that you go to annualcreditreport.com. We'll talk a little bit more about that in a few slides, but at least once a year. You have the option as a consumer to also get all 3 reports at the same time. So if you have never seen your credit report, this is going to be one of the strongest points that we can say in this webinar. So you could get it once a year, your credit report, your credit history, once a year. And now the Federal Trade Commission did permanently approve consumers to be able to get that once a week. That actually happened. They extended it twice during the pandemic and recently made it permanent. So that's great news. You can get your credit report once a week. So like I said before, and I want to reiterate this, the recommended place to get your credit report is annualcreditreport.com. Why? It's the website that was set up as the result of the Fair Credit Reporting Act that states you are entitled to receive a free copy of your credit report from each of the 3 credit bureaus. So that annualcreditreport.com is really the best place. It's who we recommend that you get your free credit report from. So we talked about during the COVID pandemic, they extended it twice to where consumers could get their credit report once a week. And finally, they made that permanent. So instead of once a year, you can go to annualcreditreport.com and you can get your credit report. Well, because there's so much fraud and there's scam, internet sites out there, make sure that you type in annualcreditreport.com into your browser, whatever browser you're using. Don't click it from a site, don't click it from an email, because there are a lot of sites out there that are actually not valid. So it's really important, and that's really with any website. We talked about this last week. You definitely want to type in that URL into your browser just to make sure it's them. And a lot of times you're going to see that lock, and that's going to let you know that it is actually them. So before receiving your reports, you're always going to be asked some out-of-wallet, out-of-pocket security questions. They could even be trick questions. I don't know if you guys have ever had this before, but it might say something like, you opened a mortgage in around May of 2008. And it may even ask the name of the lender, and you have never opened a mortgage. Don't let that take you off guard, because it's multiple choice and it will say none of these are applicable. So that's what you would want to choose. It's just them ensuring that you are who you say you are, which is always what we want to do to protect your personal information. So there's also a form you can use if you prefer, if you request your credit report actually by mail. I personally don't recommend this because we talked earlier about what is on your credit report. It has your name, it has your social, it has pretty much everywhere that you've lived, your addresses. There's a whole lot of non-published personal information on that credit report. And if that mail got lost or in the wrong hands, that could cause identity theft. So be really careful if you do choose to get your weekly or your annual credit report by mail. And we talked about this before, but I'm going to reiterate it again. If you anticipate the need to borrow money, we really recommend that you review your credit report at least 6 months prior, so that if there are any errors, any questions whatsoever, you've got the time to correct them before you apply. And that way you can make sure that you're getting the best interest rate, the best term out there. It's so important to save yourself money. So, I want to make sure you understand that only the credit reports are free, your actual history. If you want the score, there is a cost. But here's where I want you to know that the United States Senate Federal Credit Union, your credit union, when you set up your online credentials, there is, over on the left-hand side, there is an Experian credit score, FICO score check that you can get your score once a month. You do have to opt into it. It is completely free and it does not impact or affect your credit score at all. So don't pay that $6 to $8 per bureau, because your credit union gives that information to you completely for free. And what happens is once a month, you're going to get an email that says, hey, you have a new credit score available to you. So a lot of members have called in and said, hey, is this a legitimate email? Yes, it is. If you have opted in for us to provide you your Experian credit report once a month for free, you're going to get that email to say, hey, it's available. And that way you can go in and look at it and you can strategize what you need to do if you need to make it, if you want it higher. But we do recommend that you pull your credit at least 6 months before you're going to borrow, just to make sure there's nothing on there that you're not aware of. So what if there is something on there that you're not aware of? If you do find inaccurate information on your credit report, you absolutely have the right and you need to file a dispute. First, you will want to dispute the item with the creditor or the collection agency. So you're going to want to go back to the creditor or the collection agency first that reported the credit bureau inaccuracy, because sometimes they make errors. And when you make them aware of that, and a lot of times you have to provide them proof of what you saw in your credit report, and they'll fix it for you. You won't have to go through the credit bureau. But we want you to know, if that does not resolve the issue, you can file a dispute with the credit bureau that is reporting the inaccurate information. You are going to need to include any documentation to support your dispute, and it does take about 30 to 45 days. That's why we always say pull it 6 months in advance for them to complete the investigation. So it does take a little bit of time. So you can actually file with the Consumer Federal Protection Bureau as well. If you're still unsatisfied with the outcome of the dispute and you see the information in front of you, and everybody should know that these slides will be available to you on our website. And then identity theft. You know, if you find indication that your identity may have been stolen, it's important to take action immediately, literally immediately. You can contact all 3 credit bureaus to place a freeze on your credit. This typically prevents anyone who has your information. It stops them from being able to open accounts as you. You can typically do this by calling the credit bureaus or going online to their websites. And a lot of times, if you report it to one credit bureau, they actually will report it to the rest. But putting that freeze, we actually have lots of members who apply for membership here at the credit union. And I'm going to say 9 out of 10 have a credit freeze. They've not had identity theft. They've not had any of their information compromised. They're just savvy consumers. And they know that placing a credit freeze on their credit bureaus will keep anybody from being able to do anything with them. So, you know, it's also recommended that you go ahead and be proactive and put that credit freeze on there. It's also recommended that you file an identity theft report. A lot of times you're going to need this. That's with the Federal Trade Commission, the FTC. And this report will walk you through the additional steps to take. So it walks you through step by step. They just released information recently. It takes a consumer whose identity has been stolen 6 months or more and 200 to 300 hours of the consumer's time. So do everything you can to protect yourself and keep that from actually happening. So here's something I love to talk about, because there are so many factors that go into calculating your credit score, and a lot of people just don't know. So we want to make sure that we give you, the information as to what is on your credit report, and making sure that the information is reporting accurate. But it's also very important because your credit report is used to calculate that actual credit score. So a credit score is a 3-digit number. It uses the information on your credit reports from your credit history to actually quantify the likelihood of repayment by reviewing how you have managed previous accounts. It's actually meant to reflect how risky it may be for a creditor to extend new credit to you. Those scores, if you're not aware, they range from 300 to 850, 300 being the lowest, 850 being just the best, excellent credit. And some people can even have a 0 score just because they don't have any credit history at all. So the lower the score, the higher risk an individual is to a creditor. So that's why it's so important that you sign up for the Experian free credit report on our website, and that you pull your credit report at least once a year, but you can pull it once a week from annualcreditreport.com. So the FICO score is the most widely used scoring model for your score. Another model is called the Vantage score, and it's typically used by sites that offer free credit scores. And because they are different credit scoring models, your score could vary depending on where you check it. This doesn't necessarily mean one is wrong. It just means that different scoring models took, look at slightly different things. So 5 key factors, five key factors go into calculating your FICO credit score, which is, again, the most common scoring model used by creditors and lenders, is the one that's called FICO. So the largest factor, 35% impacting your score, is your payment history. So we've already talked about this before. Making every payment on time every single month is one of the very best things you can do for your credit score. The second largest factor impacting your score is amounts owed, which includes credit utilization. So creditors want to see loan balances decreasing, not hovering or increasing over time. So let's talk about credit utilization. Specifically, it looks at revolving credit accounts like a credit card, where your balance could actually go up one month or down the next. Credit utilization looks at how much of your credit limit you're actually using. The more credit limit you actually use, the more risk you are to a creditor. If you have multiple credit cards, what you want to do is you want to add up your balances, divide them by the total of your maximum limits, and that's your utilization rate. And ideally, you do not want to use more than 30% of your limits at any time. It can actually affect your score. And even more, ideally pay your balances off in full each month. So length of credit history looks at how long, this is 15%, how long your credit accounts have actually been open. This includes the age of your oldest account, the age of your newest account, and then they average all of your accounts. So the longer your credit history, the better. And then, of course, they're going to look at new credit, which is where those hard inquiries we discussed earlier are actually reflected in your credit score. If you start applying for credit frequently, this can be a red flag to creditors. And the best analogy I can give you is, and I'm a big shopper, I think I say this every time on these webinars, I love to shop. I just do. And everybody knows the day after Thanksgiving is one of the biggest shopping days of the year. And what happens when you go to each merchant? When you go to check out, what do they say to you? Hey, do you have our credit card? No, I don't. Well, let me save you 10%. A lot of times they'll even tell you what that amount is. And, you know, you're typically Christmas shopping, holiday shopping, so it's going to be a lot. My recommendation is say no every time. I say no every time. Now, when I was in my early 20s and I was not credit savvy, oh, I'd want to save it every single time. Yeah, give me that 10% off. But I have evolved and learned that that is really going to, that 10% is not going to save you how it's going to impact your score. So that's about the best analogy I can give you. But of course, typically everybody needs to apply for a credit card from time to time, which is totally understandable. The key here that we want you to know is to be strategic. And when you do apply, limit those hard inquiries to only when you need it. Because hard inquiries typically remain on your credit report for up to 2 years. So it's really important. Don't just go merchant after merchant after merchant just to save that 10%. And then finally, credit mix is the last factor that's going to impact your credit score. Creditors want to see that you have a history of managing different forms of credit at the same time. And the example that I can give you is like maybe a credit card and a car loan and a student loan. This is probably one of the smallest factors impacting your score, but it can actually help to have more of a well-rounded mixture of types of credit when they are managed responsibly. So there you see it. There it is. That is what impacts your credit score. So how credit scores are calculated. So let's apply what we've learned so far. And you see an example in front of you. We're going to look at Diego and Angela again. And for our purposes, each of them only have one credit report on their report. So Diego spends, as you can see, $800 on his credit each month. You can see his limit's $1,000, and each month he pays it off in full, avoiding all interest charges. Now look at Angela. She has carries a $5,000 balance. She also pays on time, but only makes the minimum payment, and her limit is $10,000. So who do you think has the better credit score and why? So let's look. You might be surprised. Angela. Angela has the better credit score. You know, despite being in more debt and probably it can take up to 17 years, depending on your balance, to pay down your balance plus a bunch of interest. There is one thing working for her, and you probably already know what it is because we went over it. The ratio of her balance to her overall limit. So we talked about utilization percentage. Hers is 50%, Diego's is 80%. But with that being said, while Angela may have the higher credit score, and we talked about financial wellness, right? Diego is in a better financial position. So next month, he can simply charge less on his card, and within 30 days, his score actually could improve. Angela could struggle to pay down her debt because she's only able to afford minimum payments. So credit scores are a piece of your financial situation. And it's important for you to remember a credit score is not, and I've said this before, I'm going to say it again, not a financial health score. So how do you build credit? What if you don't have any credit? If you've never had credit, how do you build credit? How do you rebuild credit? Let's say you've had a setback. How do you rebuild it? We're going to give you the education, the advisement on how to do that. So as you focus on building credit, you'll first want to review your goals. We talk about this in every webinar, how important goals are to your financial wellness. You're going to want to know what you're trying to accomplish. It's going to help you determine the steps that you will take as you move forward. Also, before building credit, consider how financially stable you are. And we say this every webinar as well. Have you developed a written budget? Do you have consistent income, and is it enough to cover your monthly expenses? I can't imagine anyone who goes through life that doesn't do this, because you just don't know until you see it on paper in front of you. Do you have at least, several $100s? We've talked about this before as well, in savings to cover, a minor emergency, a minor setback. If you open a credit card or add a loan payment while you're struggling financially, this could end up negatively impacting that credit score. And then one of the most common ways to build credit is opening a credit card. Using a credit card for a budgeted expense and paying the balance off in full monthly is a great way to start building a strong credit history. There's also secured credit cards that you can also apply for. You make a deposit up front, that deposit becomes your limit of your card. So let me just give you an example. Let's say you deposit $300. You would be given a credit card limit with $300, and just like a regular credit card, you use the card and you get a bill each month with a statement and minimum payments due. So you would still pay interest if you don't pay the balance in full. If you make a late payment, you'll still be assessed a late fee, and this could still negatively impact your credit score. Your security deposit is only touched if your account goes into default and it's not repaid. So other than making a security deposit up front, the key is treating a secured credit card the same as an unsecured credit card. So remember that utilization score, keeping your balance low, make your minimum payments on time every month, and that's going to help you to build a positive credit history. So a secured credit card is often used to help people with no or low credit. It helps them to rebuild, as it's less risky, of course, to the issuer because of the security deposit. And as the credit score improves over time, you can eventually receive your deposit back from the creditor. So keep in mind, a prepaid debit card is not the same, as they don't report any information to the credit bureau. So the next thing, student loans, not student loans, a secured loan. That's another good way to build credit. So let's say you have money in a certificate of deposit, a CD. You can actually borrow from that certificate of deposit up to the maturity date. And the interest rate's going to be a lot lower. Plus, you're going to actually continue to earn the interest on your money. So that's another great way to build established credit. You'll want to talk over the options to building credit with your financial institution, which we hope it's United States Senate Federal Credit Union, to ensure that you are using the right product based on your goals. So it's important, to have that conversation, communicate to us. We're always here to help guide you. and help you be financially well. We talked about secured loans. And then, of course, cosigners. You also have two choices when it comes to using someone else's credit to build your own. The first of which is getting a cosigner. It is very important to know, however, that both parties are legally and equally liable for the debt. If you plan to go this route, there is risk involved that is important to weigh, and to have a clear agreement in place with the other individual. And then authorized user is another option. Being added as an authorized user to a credit card means, authorized users are not considered account holders, so you are not liable for the debt. But keep in mind, any activity on the account will be reflected on your credit. So this is actually reported. You were reported as an authorized user to the credit report, good or bad. If you're considering asking someone to add you as an authorized user, make sure it's someone you can trust to make their payments on time, because you're not responsible for the payments. And keep their balances low to ensure this helps you build credit and doesn't end up actually harming you. So let's talk about common credit myths. There's a couple most common credit-related myths you may have heard, and why they are not necessarily true. Myth number one is something we all hear a lot. Closing a credit card will hurt my credit score. I want to say this is kind of a half myth. It all depends on the person's situation. So let's take a look at a couple examples. So in Sarah's case, you can see Sarah in front of you on the PowerPoint slide. She has 3 maxed out credit cards. Since she is using 100% of her available credit, the utilization portion of her score suffers already. Now, she pays off the first card, so her available credit increases, so her credit score improves. So then Sarah decides she's going to close it, and she is not tempted to use it again. A lot of us do that. But once she closes the card, her available credit on that card disappears. So she's left with that utilization ratio of now 100%, and her score goes back down. So remember, the other 2 cards remain maxed out. So in Sarah's case, closing her card has actually hurt her credit score. So to the right, you can see Katie. In Katie's case, she has opened 5 opened accounts, and her starting utilization ratio is great since she's using very little credit. So closing one of her cards will have very little effect on her utilization ratio. So her credit score will not be affected as significantly as Sarah's, though she still may see some impact. This is a really good reminder that credit scores are not, and here's that word again, not financial health scores. So Sarah closed that card to remove, of course, the temptation. She didn't want to continue charging on it. Yes, her credit score may have been impacted negatively, but she made a financially wise decision for herself. Bigger picture. This is another reason setting your goals is an important part of this. If Sarah's goal is to get her debt paid off and she isn't planning on needing to apply for new credit anytime soon, her goals can actually help her make different decisions than if her top priority is improving her credit score ASAP to get the best rate on a new loan. So lots to think about, So, has anybody heard the myth? This is myth number 2, to not check your credit because it will hurt your credit score. Anybody heard that myth? So checking your own credit score, credit history is actually a soft inquiry, and it does not impact your credit score. So again, it's really important that you check your report as often as you like. It will not change your score. So myth number 2. So this myth is derived from the fact that applying for credit too often can hurt your score. Like we discussed earlier, when you apply actually a hard credit hit, like when you apply for, some type of loan, an auto loan, a mortgage, that's considered a hard inquiry, which is different from the soft inquiry when you check your own credit. So that's great news. So since credit cards are one of the most common methods people use to access credit, we are going to spend the rest of our time with some tips on using credit cards wisely. So having money in savings as a backup so you can handle an unexpected expense without getting into debt using your credit card is a great place to start. It really is. Everybody needs an emergency fund. And consider only making, one charge a month, and make this charge an automatic bill, such as things like internet or cell phone. And the reason we suggest setting up only one automatic charge is that you only need to generate activity to build your credit score. It doesn't matter how much activity. Activity has nothing to do with it. In fact, the smaller the balance, the lower your utilization ratio. And as we've learned, this accounts for 30% of your FICO score. So committing to use the card for only a small automatic expense you'd pay for anyways, and leaving your credit card at home, it can actually help you avoid the temptation and overspend. And the lower the utilization ratio, the better. So a general rule of thumb is to use less than 1/3, we've already talked about this, of your available credit. For small limits, this means only charging a very small amount. It is important to know both your limit and that 30% number. So you want to stay within 30%. And we gave you the formula for that earlier. And then, while paying off an account in full does not improve your credit score per se, paying on time is actually what really matters. Paying off the balance in full can help you, of course, from avoiding paying additional charges like finance charges. It will also help you to live within your means without increasing debt. And then you always want to check your credit report and your score regularly for accuracy. And I want to just say that the United States Senate Federal Credit Union has the best credit card out there. We really do. There are no hidden costs. There are no annual fees. It is the best card out there. The interest rates are low. There's no balance transfer fee. There's no over the limit fee. And you can actually earn rewards. So let's say you pay your card off every month. Who cares what the rate is? Because you're never going to pay finance charges. So, we have a Visa Smart Rate. We have a Visa Smart Reward card. And one is 13.5%, one's 14.5%. They have the Senate seal. They are very prestigious cards, and there just aren't any hidden costs. A lot of these credit card companies just can really charge you outrageous fees. Their limits are typically high. I think they can be as high as 30, maybe even 40%. And if you miss a payment, not only do you have a late payment fee, but they can actually increase your interest rate. So you want to be really, really careful. I 100% really recommend the Senate Credit Union credit card. So if you would like to take a closer look at a specific credit situation, we partner with GreenPath Financial Wellness. They are amazing. They are the nicest, most respectful. They'll make you feel like family, just like we do here at the credit union. We encourage you to call them. They'll actually look at everything for you for a free confidential financial assessment. They are certified counselors, you guys. They can review a soft pull of your credit report with you. They can talk about steps to build or improve your credit score, especially if you are getting ready to borrow money. And I want to say, especially like for a home, you want to make sure that your credit is ready, your credit score is ready to absolutely get the best rate out there. And GreenPath, their financial counselors just are amazing, and they can absolutely help you. Even with things like, housing, student loans, any debt at all that you have. So there's the information in front of you for GreenPath. We are actually coming to an end with our webinar. I did want to say real quick, I said a lot about your credit score is not your financial wellness score. So somebody may have had the question, I don't know if you do or not, as to what that is. And those, are things like sticking with your budget. You want to have a solid emergency fund in place. We talked about that. You want to make sure that you know how to manage your money. Just some of the things that I thought about, not living beyond your means, understanding debt and how to manage it are just a few of the things that I thought might come up as a question. So thank you guys so much for the opportunity to present this. We really hope that you took something away from it. That's always our goal, to provide you with resources, information, education that will help you be financially well. We absolutely care about you. You're our member. We always say no member, no credit union. So thank you guys so much.
Thank you, Kim. That was amazing. Thank you so much. What a great presentation, you all. And like we said it at the beginning, March is actually National Credit Awareness Month. So we were so excited to present on this topic, and with everything that Kim gave us, I mean, I really hope that you found this helpful. And I know we want to be mindful and respectful of everyone's time. We are 2 minutes already past or normal end time, but again, I do know that we have a lot of great questions, and as we stated at the beginning, it's all commitment that we answer every question before we head out. So so with that being said, Eddie, Andrea, do you guys want to go ahead and read some of those questions that we have? I believe there might be some questions that might be very similar, so we can combine those questions if you guys don't mind putting those together for us.
So the first question is, why are some of my credit scores as much as 30-point difference? For example, my USFCU credit score is 30 points difference less than Experian. Anyone?
Take that one.
So, go ahead.
No, I was just going to say that we Kim talked about this during the presentation, and in essence, every lender or every company, they have different systems. It really comes down to what are some of the things that we look for, what are some of the reporting. So not all credit bureaus report everything at the same time. So oftentimes you will run into a situation where your credit score will be significant, different than what it might be with the other bureaus. For example, the score that we provide with the in our platform, in our website, is the FICO score. But I know we have a lot of people that use Credit Karma, and Credit Karma, actually theirs is not FICO. There's actually an actual credit score, and that score will most likely be way different. And the reason for it, again, it's that the factors that they take in when they're coming up with your score is way different than what we use. For us, is we're using FICO. So again, it really comes down to the to the company that is pulling your credit, and what is some of the information that they're retrieving, and that it's what pretty much is what's making up your score. Another thing too, Kim alluded on a presentation, there's the FICO score, there's the Advantage score as well too. So those two scores are different. Again, they all look at different items, and everyone again uses different bureaus when doing so. So that's one of the things that I did wanted to highlight. Kim, do you want to add anything to it?
I was going to add that I would have to ask a few more questions, like where are you seeing that difference? Because we do use Experian. So if you are the consumer and you're pulling your credit and your credit score, it is going to be different than when a lender, when you actually apply for a loan and a lender pulls your credit score. Not exactly sure why, but I can say that when the consumer pulls it and the lender pulls it, there is somewhat of a gap, a difference.
Thank you so much. The next question is, can you address the best way to get a competitive loan rate without harming your credit?
Again, do your research. A lot of lenders have their rates out there. But I will say when you do apply for a loan, 9 times out of 10, it is going to be full underwriting. They are going to pull your credit. And, if you're not pulling your credit over and over and over, it is not going to impact it that much. It may go down a couple points, but as soon as you start making those payments, it's going to go back up and probably higher.
Absolutely. And I also want to add to that. There are, I know of at least two companies, online companies, that they can help you. So if anyone is interested in getting any particular, whether it is if you're thinking about a debt consolidation, or just a regular personal loan, there are a couple of resources out there that you can use. I don't want to name any companies, but I do know two that are very popular. All you have to do is just go on Google and search their names. But what they will be able to do is they will be able to go ahead and do a soft pull and shop for the type of loans that you're looking for, without having an impact on your credit score. And obviously, once you decide who is going to be the best company to go with for whatever loan that you're looking for, that's when the hard inquiry is going to be posted to your credit. I will say, if you're thinking about any personal loan, and you do use one of those resources, and you want to get a second opinion, come and talk to us. We'll be more than happy. If once you have decided that you want to pursue a particular loan, you can go ahead and apply with another company, and the impact will be just one hit to your credit. So that's another thing that I did wanted to mention. A perfect example is when you buy in a car. If you want to go and buy a car, if you go to a dealership, the dealership will take one application, but what they do is they will go ahead and submit your credit to multiple companies, and that again will only have one impact to your credit score, although multiple financial institutions will look at it. But it would only take one hit, so it would only have one hard pull that will report to your credit. Hopefully that answer that question.
And Milton, in the Experian FICO score tool, that's an online banking, there's a credit simulator in there. So you can play around with it and see how maybe taking out a loan, this type of loan might affect your score, or if you paid off this, how would it affect your score? So that's kind of fun.
So talking about credit getting impacted, does retiring hurt or lower your credit score? Is that a myth? Is that something that's true? Is that a fact? What does the panelist team think? Does retiring hurt or lower your credit score?
It will not hurt your credit at all. Just keep in mind that if you're retired, you will still have income coming to you. And so, oftentimes if you're thinking about getting any type of loan, and you have an excellent credit, there will be multiple factors that will decide whether or not you can get a loan. And obviously, another one thing that the lenders will look for will be, do you have enough income to pay for the loan? So although you might be, already, enjoying retirement, but as long as you have income, whether it's your Social Security, whether it's, any retirement accounts that you had in place, as long as there is income coming through, that will not have any impact. Because remember, your credit score is something that you work for so many years, and it is so hard to get to an ideal score. And as long as you maintain it, you make all your payments on times, you follow the steps that Ken mentioned, credit utilization at 30% or less with all your credit cards. If you have a mortgage loan, a car loan, make sure those payments are always on time. And if you do so, that will be key, in maintaining your credit score. And as long as there's income that you have, that can justify it, to make the payments for any of the loans that you're looking for, you'll be fine. So again, retiring will not hurt your credit. So that's definitely a myth, for anyone that is concerned about, whether or not if you retire, will that lower my credit score? And the answer is no.
Look at us calling us mythbusters. We deciphering over here if the myths are true or not, if they're facts. So thank you very much for that explanation, because I know that's a question that comes up quite often when our members want to retire or people that we know. So that's good to know, so we can emphasize and that it wouldn't hurt their credit. So if you're ready to retire, by all means, go right ahead and live the life. Do you see any other questions on your end, Andrea?
Yes. If I have 6 credit cards, is it better to lower the maximum limit on each card to get my credit score higher?
So
Okay.
again, the FICO score is going to be based on that 30% utilization ratio. So if you're not using the card, you might want to lower it just for fraud protection. The higher the limit, the more open you could be to someone compromising your number. So that's totally up to you. But really what goes into that FICO score is that utilization ratio.
If an error is found on our credit report, is it easy to figure out how to correct it?
Yes, absolutely. I mean, once you've discovered that there's an error, you definitely what you will do is you can go ahead and file a dispute with the credit bureaus. If all the 3 bureaus are reporting the same error, then again you have to reach out to every single one of the credit bureaus. But before you do that, I will advise. I highly suggest that you do a more in-depth review of your credit, because if there's an error, it could pretty well be an error, but then again, it could also be a red flag that perhaps your information has been compromised, and somebody might probably has a hold of your information, and you might be a victim of identity theft. But if that's not the case, you can definitely dispute any errors. You just have to go into each one of the credit bureaus and file a dispute to do so. Again, hopefully that answered the question.
Why would one use Vantage over FICO?
It all depends. It all depends for the company, the lender. I can tell you that FICO is what we use here at the credit union, and then we're very specific as to what we look for when it comes to credit. And the other one, I see it a lot with like car dealerships. They like to use a score. Why? Again, everyone has their own preferences. And so it all depends on the type of lending that you're looking for. There are certain industries that are very particular And I have seen Advantage being used a lot with dealerships. And then perhaps there's more details that they can get with that reporting. So that might be one of the reasons why.
And I believe we have one more question, but if I'm wrong, Eddie could tell me. Does USFCU ever offer credit card account opening bonuses?
We have in the past. There
We-
hasn't been one recently, but you gonna take it, Carrie?
Oh, well, I was just gonna say, we do, for our rewards card, we do bonus points sometimes, like around the holidays or coming up for moms, like May, moms, dads, and grads. That's kind of one thing we do. And over the summer, like open up your card and get a X amount of bonus points that usually translates into cash. But that promotion is never really that successful. So I like that cash one, and I'm going to bring it up to my boss tomorrow. So hopefully, so stay tuned.
Okay, do you see?
You already know if Carrie comes off mute, she got some great information for us, guys. So stay tuned with the promotions. Like she's saying, we always got something going over our credit cards. And if you want to talk about our rewards credit card, if you want to take notes from somebody that has so many points, talk to Carrie. She'll give you some advice on that.
Thank you, Eddie.
Last question. Is that 30% of all your credit cards, or is it for each credit card?
So it will be per credit card. So remember, every credit card company, they all report to the credit bureaus. So if you lower your 30% usage on all your credit cards, there's a good chance that one credit card might have more than the 30% limit. And it's all, at the end of the day, it's what every company reports to the bureaus. So that so that's the reason why we said go ahead and then keep it with every credit card that you own, rather than do the average with all your credit cards and keep everything at 30%. So don't want to do that, because that will put you in it might expose you and then get you in a position where if you have multiple, especially I'm not sure if we share the report as to what's the average of number of credit cards that most Americans have, but I do know that it's over 4 credit cards per person. So if you have 4 credit cards, and then some of them with different limits, so that can definitely have an impact to what's being reported by every credit company. And if I'm not mistaken, I believe Mr. Juan wanted to come off mute, and then he has also some information that he wants to share with us regarding credit freezes. So, Mr. Juan, if you're still with us, the floor is yours. We do want to be mindful that we have 3 more minutes before we had to leave the webinar. Thank you again for always participating with us.
Sure, there's only one short, quick comment. So Kim, you did a great job on covering credit freeze and stuff like that. There is one other thing too. I go on there quite often, all those ones. You can do a temporary freeze too. You can put specific dates on when you want. So when you're applying for credit, if you know you're going to apply for credit with a credit card or a loan or whatever, like often I'll go and do certain things like that, apply for a credit card, I'll take the freeze off, but I also know that I'll be done in a week. So I'll put the credit card freeze only on for 2 weeks. So you can specify dates on those websites. So that's just a little tip in case that way you don't have to remember to go back and lock it afterwards. So that was just one thing. 2 other things I heard on the news today, kind of scary. The credit card limit is now 1.15 trillion. So we all have to be careful on how much we spend, but it's at an all-time record. And the last thing I heard today on the news was something about they're trying to limit the fee the banks charge on checks, I think. That was news on today. So
I saw that too. I think it's
$35
the
to
late
$6.
fee, 8% at big
Right.
banks. They're trying to limit it to that.
exactly.
It's,
That was all my comment. But thank you again.
Good info.
Thank you
Somebody
so much,
watches
Mr.
the
Wong.
news.
Great information. We
Thank you,
appreciate you.
We truly appreciate you. And again, thank you all. I know we still have over 30 people connected. So again, we just want to take this time and just say thank you all so much for joining us every Wednesday. And before we let everyone go, just want to remind everyone that about 2 weeks ago or 2 or 3 weeks ago, if I'm not mistaken, we were scheduled to host our retirement planning 101, but unfortunately, due to something that was out of our control, we had to postpone that webinar. So again, we know we had a lot of people registered for that webinar, so we're bringing it back for next week. So if you want to know more about retirement planning 101, I know we had a couple of questions connected to retirement in this presentation. So if you're interested, please, we invite you to come in and join us again next week, all about retirement planning. So and this is a reschedule from a couple of weeks. So again, thank you all so much. Appreciate you. And we look forward to seeing you again next week, and our amazing panel. Amazing job like always. We'll get back at it again next week. So hope you all have a wonderful evening now. Thank you all so much.
Can't wait to see everybody next week. Thank you.
Thanks.